So it's not just interest rates. It is a panoply of headwinds that have hit the multifamily and, in fact, the commercial real estate industry in general.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. Glad you're with us here again today. Of course, I'm your host, Jeremy Dyer. I have a wonderful guest with me today, Adam Gower. Adam, welcome to the show.
Thank you for having me, Jeremy.
I'm really excited about this today, mostly because you're a fairly high energy guy. I got to know that in the brief 5 minutes that we had a chance to catch up before the show. So really appreciate you being here with me today. To hit the ground running for my audience, Adam is a 30 plus year real estate veteran with over, get this, $1.5 billion in commercial real estate investment and finance experience, who today is building a digital marketing system for real estate professionals who want to raise equity capital online. All right. Yeah. Well, with that said, Adam, tell us more about your background and kind of what you're focused on today.
Yeah, sure. Thanks. And really thank you for having me as well, Jeremy. It's a real pleasure to meet you and to be on the show. Thank you.
Of course. Well, there was 10 other people that I had the opportunity to bring on, and I just had to take you.
Well, you know, I love it when people say, yeah, you're my 500th guest. Oh. You're really scraping the bottom of the barrel now, aren't you?
Yeah, well, don't screw this up because we might want to have you on the show again in the future.
All right. So my background, you're right. I do go back a long way, a lot further than I really like to remember or share, to be honest with you, but into the 1980s. I mean, I really go back a long way. So that's when I started my career pulling wires for an electrician. I'm going to move through my career very quickly. I then started doing investor relations for a ground-up multifamily shop in Southern California, raised in 1980s money about $30 million of equity from individual investors. It was a lot of money in those days.
Yeah, that's like $75 million today.
I think probably more than that even, but it's a significant amount of money in those days. Then I ended up in Japan. I ran a division of Universal Studios, actually a JV, Universal Studios and Paramount. I did all their real estate development in Asia Pacific. And then I came back here, started to do my own deals. In 2007, sold out, so right before the GFC, the global financial crisis, and was brought into East West Bank, a major regional bank, actually the largest regional bank, headquartered in California. And they needed somebody to help them clean their balance sheet of non-performing real estate collateralized loans. They had a big portfolio. So my job was to sell those loans individually at the time, to individual investors. So this, when I say invest, I mean sponsors. There was crowdfunding or online syndication was not legal in those days. So the people I dealt with were what I call sponsors. From there, I ended up at Colony Capital, who had bought over $7 billion of non-performing loans, actually in partnership with the FDIC. And my job over there was the same thing, basically. These were reperforming and non-performing loans. And then once the economy picked up, I started doing seed and angel investing in startups. And that's where I learned the world of digital marketing, OMG. So when the 2012 Jobs Act was passed and it became legal for real estate sponsors to raise money online, basically to advertise, I set up Gower Crowd. And what we do now is, on the one hand, we educate investors. So we have a huge amount of educational content, both free, some of it's premium content, but 90% of it's free on the website at gowercrowd.com. That's for investors, passive investors, right? Accredited investors primarily. But our main source of income, our main business, is in building what I colloquially would call a crowdfunding platforms for sponsors who want to get their story out there, who want to raise money from accredited investors. So that's basically what we do. Now, I will continue with one final thing. The world has changed dramatically, Jeremy, as you well know, particularly in the last 18 months as interest rates have gone up. There's a lot of distress out there in the market. I mean, really significant, significantly more than anybody really realizes at this point. So we have pivoted, as you really have to do, and adapted to the circumstances. And so what we've been doing is focusing on assisting on two sides. One, actually on three. One, on assisting sponsors to put together effective capital calls. And that's, in fact, everything you see behind me on the board. For those who are watching, is this whole schematic that describes the process of what happens when money runs out on a deal, when a deal starts to struggle, and then how to deal with that from a sponsor perspective. We're also creating a lot of content, educating investors, accredited investors primarily, on what to look for and how to understand this new world. Because for a lot of sponsors and actually for a lot of investors, a downturn, this is the first time they've seen a downturn. Oh my goodness. So having a guide, somebody who can guide you through it, know how to deal with it, is indispensable. Most people don't have that kind of help. And so we put together some very extensive educational materials that help you through that. And then helping sponsors with capital. Oh, and then the third thing is finding opportunities. OMG, right? I mean, there's a lot of distress. People are losing money, but this is a period of wealth transfer. So those people who are losing money are losing deals to other people who are now buying at discounts. So we're also working on that side of things.
Well, I had 1,800 questions that I was going to ask you, but now I've completely pivoted the questions that I'm going to ask you based on what you said. So my question for you is this, and understand that some of our listening audience are a little bit more sophisticated than others. I want you to help us understand, why is now a unique time in real estate investing as opposed to what it has looked like over the course of the last decade? What has caused some of the headwinds that maybe investment sponsors are feeling today?
Well, the headwinds, the reason that the market is in turmoil is it's always the same, actually, Jeremy. I mean, at the end of the day, the reasons for that stimulate that really underpin the real estate cycle, and it is a cycle. There are always ups and there are always downs. There are always recoveries, right? I mean, it's predictable, basically. But what really drives that at all times is liquidity, the amount of capital that is actually available in the market primarily to sponsors, right? People, professionals who are out there building or renovating apartment buildings. And we could talk about any asset class that you like, but typically, the most popular is apartment buildings. I will, as a side note, tell you, one of our clients is a farmer, major, like big scale farmer, although he doesn't like to admit he's so big, in the Central Valley of California. I will tell you, it's zero impact, nothing going on in the market. I talked to him, he says, yeah, the citrus is coming in nicely. It's crazy. It's like farmland, of all things. It's like almost immune. Not quite, but almost. Anyway, I digress. So liquidity is what drives the commercial real estate investment cycle. And so what's been happening over the last 10 years, up until about 18 months ago, was an excess of liquidity. Banks were lending at increasing rates. Bridge lenders entered the market. So now we are getting a little bit more technical, but bridge lenders with significantly lower underwriting standards entered the market. So that pumped massive amounts of liquidity in the market. And then the third prong, if you like, or the third pillar of liquidity over the last 10 years, of course, has been individual investors. It was never allowed before. So you've got institutional investors pumping money into the market, as usual. Seasoned private equity shops also bringing capital into the market. But for the first time ever, you've also got individuals signing $25,000 checks. And that amounted to billions and billions of dollars, actually, over the last 10 years. So a lot of liquidity. And what liquidity does when there's so much demand and there's so much cash is it pushes prices up as people start competing. As sponsors compete. So there was all this money. We want to get the deal. And so that was pushing prices up. So now, as soon as the Fed pushed their foot on the brakes of the economy and started increasing interest rates, liquidity dried up, just like abbreviating this. Liquidity dried up. So banks have stopped lending. Bridge lenders have basically ground to a complete halt. And all these individual investors, not all, but a large number of individual investors, because prices are starting to come down as interest rates go up, individual investors also are pulling back. Because why? Because they're getting capital calls. Instead of getting checks, they're getting asked for more checks for deals that they already invested in. So as liquidity dries up, now deals that go out on the market, and I'm oversimplifying a little bit, but when properties go out on the market, assets go out on the market, there is no cash. And so what happens? Prices come down. That's what happens. Prices come down because no one's buying. So we are actually at the very, very cusp of the tipping point, if you like, right now of the prior cycle and what will be the next cycle. So we are in a kind of the throes of a frozen market.
Based on what you're kind of saying, and obviously I'm hearing it, on the street, as well, that, sponsors are executing their value add business plans. They're even achieving rents that are in excess of the pro forma. The challenge is on the debt side, right? It's not that the deal is bad, it's that the debt is getting and becoming more expensive. And I'm hearing about this wall or wave of bridge debt that's coming due in 2024. I know that you don't have a crystal ball because neither do I. What are we in store for, in your opinion, in 2024?
Okay, so it's more than just interest rates for a start, and rents, going up, and I mean, to some extent that's true. But the problem is that a lot of deals that were financed over the last, well, in the couple of years, particularly from early 21, when bridge lenders started coming into the market particularly aggressively, was that underwriting assumed that past performance will be indicative of future results. And so you had a lot of underwriting that assumed and relied upon what has transpired to be unrealistic assumptions, like, for example, rent growth rates. So if you project rent growth rates at 10% per year, 15, whatever ridiculous numbers some people will project, 20% plus, and that doesn't happen, then all of your underwriting falls apart. So that alone can impact a deal, right? If your projections aren't right. Add to that dramatic increases in costs of insurance, taxes, operating costs, costs of renovations. Inflation has really driven all costs up. And so you've got this, kind of perfect storm when not only that, interest rates have gone up and interest rates have driven up debt costs. So it's not just interest rates, it is a panoply of headwinds that have hit the multifamily and, in fact, the commercial real estate industry in general. Now, you did ask me a question, and I forgot what your question was. What was your question?
No, that's okay. I think you addressed the question. You also taught me a new word, and maybe you can say that word again. Panoply.
Panoply. Yeah, but now I'm going to have to look it up just to make sure I'm not making it up. Panolply. Yeah, panoply. Definition. It means, hang on. Where is it? Panoply. A complete or impressive collection of things. Panoply. Yeah.
Well, that's a new one for me.
Panoply of problems in this particular case. Yeah.
That's definitely a new one for me, but maybe not for our listening audience. Um, let's just cut to the chase. So let's talk
Sure.
about these capital calls. So what would your
Yeah.
advice be, maybe for that limited partner investor, that is in a deal right now where the sponsor is being transparent with the current environment and what to maybe expect over the course of the coming, months? What would be your advice to that investor before they decide to, if they're presented with the opportunity to participate in a capital call, what would your advice be for them?
All right. So first of all, can I pitch something?
Please.
It's like really crass. Okay. So I just wrote a book. It's called Rescue. It's called Capital Calls and Rescue Capital. It's a $7 book. If you don't like it, let me know. I'll send you $7. Seriously, satisfaction guaranteed. But it comes with, I think, some training from me. Actually, I walked through this whole thing in the background, and I think 6 or more hours of advice answering this exact question that you asked me from multiple experts in the industry, seasoned, multi-cycle professionals in the industry. I asked exactly this question. So you can get that at gowercrowd.com.
You might not be able to see my phone here, but I did purchase your digital copy of that book last week.
It is a digital copy. Thank you.
As per the recommendation of one of my close friends, Mr. Todd Dexheimer.
Well, thank you, Mr. Todd Dexheimer, and thank you to Jeremy for having purchased that. The video content that comes with that is first class, but I'm going to summarize basically what it is. First of all, it's a really difficult decision to make. And there are all kinds of moving parts, but you used a very important term when asking that, a qualifying term. When you asked the question, you said, assuming that your sponsor, the person you invested in, is transparent. That is the number one most important thing. You want them to be, you need to have communication. They need to be communicative. You could even ask them, what should I do? What do you think? Are you putting money into this?
Yeah, bad news does not age well.
It does not, no. And again, that's entirely what this entire thing is behind me, is all about communication, basically. So you got to look at the relationship that you have with the sponsor. Your money going in, and I'm not an investment advisor, but the money going in, any new money that you put in, you really should be thinking of that as a new investment. This is a new investment. That whatever you had invested in this deal already is gone. You got to just realize that this is lost money. You might not be able to write it off this year, but it's gone. So you've got to think about the new investment, about the capital call, as a standalone new investment. Now you can look at the blended returns potentially of what that initial capital investment was versus the new one and what it will end up being. And a good sponsor will tell you what it averages out at overall if their new assumptions work out. You've also got to compare that number with you think about, well, what's this investment? I mean, it might be, we have a client, for example, who put together a very interesting structure that actually on the capital call offered a projected, I want to say, high 20s IRR. It's just on that capital call money, but that was the way that they structured it. And it was an interesting structure, and they were very successful because it is a new investment. They're offering a new investment. The other thing you've got to consider is what are the alternatives, right? Economics speak, opportunity cost, right? If you can get 5% or more in a deposit account, maybe you want that. Maybe you want to invest in a distressed deal, right? Buy somebody else's deal that's gone bad and is now being sold discounted. You also want to think about the long-term relationship with the sponsor. Do you really, do you trust them? Are they high integrity? Are they trying their best? Communicate. Just make sure they communicate. You communicate with them. It's a difficult decision. Somebody asked me, an investor contacted me recently, asked, what about tax implications? I can't answer that because I don't know anything at all about tax. I have a kind of a visceral aversion to even thinking about it, to be honest. But so there are all kinds of factors.
Yeah, that's good. I don't want to assume that our listening audience is familiar with the terms capital call or rescue capital. Would you mind kind of giving us the ABCs?
Yes. So a capital. So in a commercial real estate syndication, when it starts, typically there's a business plan that comes with a bunch of assumptions, and those assumptions conclude with we need this much debt and we need this much equity capital. And so they'll put a deal together and investors will invest in that tranche of equity capital. Well, if circumstances change for any reason, and we've talked about a lot of the reasons impacting circumstances today, what happens is that that original business plan that's, let's say, assumed they only needed $10 million of capital, call it 7 million of debt and 3 million of equity, suddenly they're unable to execute on the business plan. So they can't renovate, they can't get rents up, interest rates have gone up, so that assumption, so they've run out of money. So they need more money. And it's sometimes referred to a capital shortfall in the contracts. In fact, at the back of the book, you'll find, if you've not looked at it yet, I think I've got 10 examples of actual contract language. It's mind-blowing what's in there. But one of the terms that's often used is shortfall. In other words, we run out of money. We had a business plan and we've run out of money. So they will call for more capital from existing investors, typically first. They say, look, we thought it was going to take 10 million to do this. You invested 3, we need another million. So you got to come up with another 33% of whatever you invested in the first place, right? So if you invested 25 million, it's 25,000. Now we need you to come up with another 8,500, whatever the number is, right? Pulling numbers out my ear. So that's a capital call when you have a shortfall. If that capital call is not successful, in other words, if the existing investors do not come up with, in this example, the extra million that's needed for whatever reason, right? Personal circumstances, whatever reason, the sponsor is unable to raise that, then they typically retain the right to go to third parties, people outside. I mean, there's loans, there's all kinds of structures, but just kind of simplifying it, they can go to third party investors, not any, right? Third parties. And they can offer in most cases, the sponsor has the opportunity to offer, or the right to offer, basically any terms they want to those third-party investors. And those third-party investors are, one term that is used for them is rescue capital. So these are rescue capital shops. The idea is that they're bringing capital in to rescue a deal. Now, in most cases, they're not really rescuing anything. They're preventing the sponsor from losing the property to the bank. So from wiping everybody out through a foreclosure. So in that sense, it's rescue capital. But the way it's typically structured is that it takes priority over all investors, over the sponsor as well, and needs to be paid out first after the bank is paid out. So yes, so that's typically how rescue capital works.
So I would assume in a scenario in which there's a capital call and the investor chooses not to participate, or in the instance of a sponsor needing rescue capital from a third party, I would assume that the direct result of both of those two scenarios is some dilution of the shares that LP investor owns in that deal. Am I saying that correctly?
Yes, that's exactly right. Yes, it could be it could be a dilution. Or it could be a question of priority. So where the common equity may have sat previously immediately after the bank, right, the capital stack. So the first to be paid out is the bank, and then the common equity, and then the sponsor. That's, kind of your usual, again, oversimplifying a bit, but the common equity, that is what your accredited investors would typically be investing in, would come immediately after the bank. Rescue capital, and that can be structured as mezz debt or preferred equities, all kinds of structures. that will come in before the common equity. So we were working on a deal. It was $100 million acquisition. It's kind of basic numbers. 70 million of debt, 30 million, not quite, but 30 million of equity. So exactly these numbers, but with a zero on it. We were
Mhm.
just, and Pref Equity was saying, okay, we'll come in. Rescue Capital was coming and say, okay, we'll give you 6 million that you need, but after the bank is paid off, you got to pay us off first with our 15% return. And if there's any money left over after that, then the investors and the sponsor get money. So, and when you have declining values, at the end of the day, it might mean there's really nothing left. Realistically, there may be nothing left for the common equity.
Yeah, maybe nothing left on the return, but maybe the original capital, there's still some meat on the bone.
Maybe. Yeah, I mean, that's the kind of thing you've really got to look at. And that's what pref equity shops will look at as well. I mean, they want to have a buffer. They don't want to be getting look, the challenge is that a lot of multifamily deals have collapsed in value 25 to 30%. So in this particular deal example that I'm giving you right now, so they've got 70 million of debt, but the property is only worth 70 million. So pref equity is looking at this saying, well, why are we lending 6? There's no point lending 6 because there isn't the value there. They have to believe that the value is going to come up enough over a certain period of time that they can recover their 6 plus the 15 or so percent that they want on top of that over a certain period of time. So it's right. So a lot of deals are just not getting done.
Yeah. So what should the attitude then be of the passive limited partner investor out there that either is faced with a deal that has a capital call, or maybe they've never invested passively before into a real estate syndication, and they're kind of hearing, of some of these, quote unquote doomsday scenarios. What should we do at this point? What advice would you have for those types of investors in terms of going forward?
So look, there is an incredible opportunity for during this period to buy discounted real estate. The real estate cycle peaked a couple of years ago, and or maybe within the last 18 months, kind of reached its peak, and now is significantly on its way down. So if you're buying at the bottom of the market, and everyone says you can't time it, etc., you can't time it. But what happens is the market does find a bottom. And when it finds that bottom, and new assumptions can be applied and they make sense when you actually underwrite a deal. So that you assume the right as interest rates, the right rent increases, the right tax rates, the right insurance rates, and you can buy using the new assumptions. That's a good time to start investing again. Because now what you're going to see, absent another, let's call it a black swan event that plunges into another, significant downturn, which is kind of a double downturn. It doesn't often happen. I can't think of any examples. Typically what happens is you hit bottom and then the market starts up again. And while people are nursing their wounds, that's the time to get back into the market and start investing again, because now you can start seeing a much longer tail. And the other thing that I would say is that probably having the key, you really want to be investing with people that have been through it, been through a downturn, and who have demonstrated integrity, who have been communicative, even if they've lost money, that they can demonstrate that they have learned from the mistakes that they made and how and why they won't make those same mistakes again. And I would also say avoid the shiny object syndrome. It's what I see happening a lot. Ooh, look, a 30% IRR. That must be good. Look for sponsors who have conservative long-term perspectives, who are focused on protecting the downside. Their upside projections will be significantly lower than those that don't look at the downside, but you've got a significantly higher chance of keeping your money long term.
Yeah.
And that, for me anyway, is the most important priority.
Adam, that is fantastic advice. Outside of the book that you authored, Capital Calls and Rescue Capital, what might be one or two other books that you'd recommend to that passive investor?
Other books of mine or kind of in general?
Yours, self-promotion here, that's okay.
All
Or
right.
potentially even another podcast that you might recommend.
Oh, well, so I have a podcast as well.
Let's
It
hear
just
it.
sounds like all I am. So
Don't
it's
be
the
shy.
real estate reality show. So that, again, there's links to that all over at gowercrowd.com, and then some other books on the homepage at gowercrowd.com. One is I forget what it's called. I've got them all here. I forgot what it's called even. It's called here's Capital Calls. The Reality of Real Estate, I think. Reality. That's what it's called. Reality. And that also dives into it a little bit, like what's going on at the moment. So those are good. They're all $7 and satisfaction guaranteed. Other books for passive investors? That's a tough question. For other books for passive books, I don't know. But I did just read Never Split the Difference. Have you read that?
It's a great book.
Christopher Voss. That's a really good book. It was actually really cool because he was like the CIA negotiator, counter-terrorist hostage. I mean, it's quite topical as well. I'm not sure exactly how topical. Depends on who you're dealing with on the other side. But really, it's a marketing book. It's really marketing. And I found that to be really interesting, actually.
We'll throw those recommendations in the show notes for our audience. Outside of gowercrowd.com, what may be one or two other ways that our listening audience can connect with you to learn more?
Okay, so you can email me at adam@gowercrowd.com or subscribe to my newsletter. I know it sounds like a total pitch fest, doesn't it? I don't mean to do that. But we've got so much stuff out there. The newsletter goes out once a week. It's free. And when you hit the button there, I literally just looked to see who subscribed, and I was blown away by the companies who the folk that subscribe work for. So I put a bunch of logos there on the subscribe page. It's really cool, actually. So you can that list. You can always unsubscribe.
Anybody that's provided this amount of tremendous value to my listening audience can self-promote themselves as much as they'd like.
You're very kind and generous. Thank you, Jeremy.
Yeah, and Adam, thank you so much for joining us today on an episode of the Freedom Point.
It's been a pleasure. Thanks for having me.
Of course. And Freedom Point podcast listeners, thank you again for jumping into another episode of the Freedom Point. Look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.